All right, let me grab my pen and look at the outline. Today's lesson is really going to focus on analysis. This is a critical part to understand for everything else in this chapter and in accounting to make sense to you. Because when something happens to a business that has a financial impact on it, we call it a transaction. And that's exactly what accounting needs to keep track of, all the transactions. And there's a ton of transactions every day. Every time a customer comes in and buys something, that's a transaction. Anytime we pay the bills, like the electric bill, or pay our employees, that's a transaction. When we buy equipment or we buy supplies, that's a transaction. When we take a loan, that's a transaction. So transactions are extremely important, and they affect the accounts. They affect the accounts greatly. So if they affect the accounts, they affect the accounting equation. And this is going to be our focus today. Next time, we're actually going to get into a little bit more detail. You're going to learn about the very, very first place accounting happens, which is in the journal. And then you're going to find out where those numbers travel from the journal. They go into something called a general ledger, and where it's a big book of accounts that shows the balances of those accounts. And we want to make sure that the balances in those accounts in the ledger are balanced. And so we'll do something called a trial balance at the end of the chapter. Okay. But today it's all about analyzing transactions. Okay. So again, what accounting is about is we have to collect and process data about transactions that happen in the company. Okay. And it's only when we have good data we can communicate financial information well. And that's going to impact decision makers. It's going to impact a lot of creditors, stockholders, and potential stockholders, et cetera. But certainly managers are going to be one of the key decision makers. And they need good accounting information. They need good accounting information to make good decisions. Chapter 3 deals with, chapter 3 and 4 deals with the entire cycle. But chapter 3 basically covers the first 4 arrows in this cycle. Everything else is part of what chapter 4 is going to be about. But together, 3 and 4 represent the entire bookkeeping cycle for a period of time, let's say a year. Okay, so you're going to be getting this bookkeeping skill over the next few weeks, and it's work. It's work. It is time consuming. I hate to say it again, but it is time consuming. Okay, everything starts because there is an event that changes the financial condition of the company. That's called an economic event. We call those economic events transactions. Accounting is all about analyzing these transactions because all those economic events that change the financial position of the company need to be recorded in the accounting record. That's part of the data that we need to collect and process and analyze. Okay. But it's always good to know that not everything that happens is an economic event. When I say economic event, I mean transaction. Okay. Not everything that happens is a transaction. Businesses interview people for work. Businesses might not also hire someone for work to start next week. Well, that's not a financial transaction. It is an activity, but it doesn't have any financial impact on the company when it's happening. So thus, it doesn't change the financial condition of the company when it's happening. It might change it in the future, but in accounting, we only deal with what's happening right now. Okay, so it's a very focused present, it's in the present moment when we do accounting. We're not thinking far ahead and putting the accounting down. We only record things as they happen. not because they're going to happen. Well, when it happens, we'll record it. Okay. But again, not every single activity is a transaction. We might be discussing our products with clients, and they just say, "Oh, it's great, great. I'll take a brochure and I'll call you later." Not a transaction. Not a transaction, because they didn't buy it. There was nothing. There was no financial event, so there's no accounting to get done. What you're going to look for, this is going to be one of those things you're going to have to study in this chapter for sure, is we're actually going to take a much broader look at the assets, liabilities, and stockholders' equity accounts, particularly in stockholders' equity. We're going to be looking at expanding retained earnings, because actually the income statement and the income statement folds into the retained earnings statement. And the retained earnings statement, of course, that balance gets put onto the balance sheet. So in essence, all of those accounts on the income statement and the retained earnings statement will end up being reported on the balance sheet under retained earnings. So we're going to be looking at that. That's a very important thing to study. And the last thing, if there is a transaction, transactions have a dual effect on the accounting equation. And that, the way you should look at this is at least two accounts are affected by every transaction, okay? At least two accounts are affected by every transaction. And that's going to be the focus of today. You're going to see the dual effect in action, and you're going to be doing it. And so this is a very exciting point in time for you, believe me. All right. So are these events that we're going to see here, we're going to start with purchasing computer, are they transactions? So in order to be a transaction, it's got to be an economic event for the company that changes the financial condition of the company. Now, so change the financial condition means the assets, liabilities, and or stockholders' equity have changed in some way. Now, they change because the accounts are affected. So let's take a look at that very, very first column, and I have some open questions for you. Now, this just says purchase computer. I think the best way to look at purchasing a computer from a business perspective is they bought equipment. Computer would be considered equipment. Oftentimes, it's going to be part of property, plant, and equipment. You learn that in chapter 2. And it's equipment that most of the time they're going to be using for at least 3-4 years. Computer equipment tends not to last a long time, but definitely 3 to 4 years without much of an issue. When they buy equipment, just like they are, so we're a company, we buy equipment from another company, it's a business-to-business transaction. They probably could give us a choice. We could probably pay cash for that equipment and take the computer home, or it's possible we can still take the computer home and they're going to give us a bill. All right. So there's a bunch of things that can happen, or ways to look at it when we purchase a computer. So let me start by saying when we purchase a computer, the financial condition or position of the company has changed, and so we have to do accounting. Okay, we only do accounting when the financial position of the company has changed. So let me give you two scenarios here. Okay. The first scenario is we bought the computer for cash. So we went into a store representing our company. We bought a computer and we just paid on the spot, paid cash on the spot. My question to you, because we're going back to the dual effect here, what two accounts are affected if I purchase the computer with cash? Can you identify, and this is an open question, can anyone identify the accounts that would be involved if I purchase computer equipment for cash? Again, a dual effect means that at least two accounts So official names of the accounts. 2 accounts are affected. Can anyone tell me 1 or 2 of those accounts from purchasing a computer with cash? Open? Open question. I have a chat here.
Yeah, I was gonna say the same
Well,
thing.
current assets, but that's not an account, right? A current asset is how we classify certain accounts. What specific account, Cam, if we bought a computer equipment for cash, what current asset account would be affected by that? Cash would definitely be affected, okay? Because we used cash to buy the computer. Everyone see that? If you use the cash to buy the computer, your cash has been affected. How has it been affected? Do you have more? Only 2 things can happen in every account, by the way. You can either have more of it or less of it. That's it. That's the wonderful thing about all the accounts and accounting. Only 2 things can happen. You can either have more of that or less of that in the account. So if we used some of that cash to buy that computer, do we have more or less cash?
Less.
We have less cash, right? So cash is affected, and it's affected in a way that we have less of it. Okay, that's one account. Remember, this is a dual effect. What's the other account that's going to be affected if we just bought this computer? Equipment, thank you. Yes, equipment is going to be, we have more or less equipment that we bought the computer.
More.
More, thank you. Yes, so we have more equipment. So this is the dual effect in action, okay? If we bought this computer for cash, 2 accounts are affected, okay? Equipment is affected because we have more equipment. Why? Because we just bought a computer, so we have more equipment. And we paid cash for it, so cash is affected, and we have less cash because we had to use that cash to buy the computer. In this sense, only assets are affected. We have more of one asset, the equipment, and less of another asset, the cash. Yes? This is how we have to think. Let me throw another one out for you. What if we bought this computer on account? We were able to, and we got a bill, which means we're going to pay that bill in 30 days. So we went in to the Best Buy, we bought a computer, and we said, look, we're a business, we need this computer. They were like, yeah, fine. Here's the computer and here's a bill. Pay us in 30 days. And we were able to leave the building with the computer and a bill in our hands. What 2 accounts were affected with that transaction? And it's an open question. Yes, in this case, Michelle is correct. It's an accounts payable, right? Because we have to pay for that equipment within 30 days. So accounts payable is going to be affected because we have more bills to pay now, right? Equipment is the other account that's affected because we have more equipment. So in this case, we have more equipment and we have more accounts payable. Everyone see? So more equipment means we have more assets. More accounts payable means we have more liabilities. And that's how the balance sheet stays balanced. Okay? Because if you increase equipment by $1 and accounts payable by $1, well, you haven't changed the equation. The equation is equal because both sides have gone up by $1, right? So it's equal. So that's good. Thank you, Michelle, for that one. All right, this is how you have to think. This is the analysis that's so critical in this part of the chapter. All right, let's look at the second one here. we discussed guided trip options with customers. So this is going to be, well, we're doing Sierra Corp, right? Sierra Corporation, our wonderful mythical company in the book here. So we discussed guided trip options with a customer. So all you did is you spent some time talking with the customer, telling them how wonderful your trips are, and they're like, yeah, sounds great, awesome. But guess what? Nothing changed, right? The customer didn't buy a trip. Nothing happened. You didn't sell a trip to the customer, right? So just discussing things does not make it a financial transaction. Nothing changed regarding the financial aspect of the company, okay? It might in the future, if that customer you've been talking to comes back and actually takes a tour. Now we're talking, right? But in this case, you're just yapping back and forth, okay? Let me throw a couple of scenarios at you here, and let me ask you what accounts would be affected in this case. And again, they're open questions, so I want everyone who can participate to participate, okay? So let's say as we're discussing the guided trip, this is like a tour, a hiking tour, with a customer, the customer says, okay, when's your next trip? Oh, actually, we're leaving in 5 minutes. Great, I'm in. Is that a transaction? And the customer puts down some money and says, okay, I'm in, I'm on the next tour. Is that a transaction? Anybody?
Yes.
Yes, it's definitely a transaction. Because in this case, what accounts have been affected when we actually sell, right? We actually sold a trip, a hike to this customer and the customer gave us cash. What two accounts are affected in this case, please? What two accounts?
One of them.
Well, it's not unearned revenue because we're actually giving the customer a tour right now.
Accounts receivable?
Well, they're paying cash. I'm
Oh, cash. Oh, sorry.
Okay. So two accounts are affected if we sell a tour for cash, okay? One is we just sold a tour, and so that's service revenue, okay? Service revenue is how we make a living. That's what we sell to customers, right? If we sell tours to customers and we sold a tour to the customer, that's revenue for our company. Remember, revenue is about what the company is selling to the customer. In this case, the customer pays cash. And so we got more cash as well. Okay. What if we gave that customer a tour? That customer said, look, I definitely want a tour, but I can't pay you now. Can I pay you later? And we say, yeah, okay. Get on the tour. Here's a bill. Pay us later. Well, then that's accounts receivable for us. That's service revenue because we did sell a tour. We're doing a tour for this guy. And we allowed him to pay us later, which means we're waiting to receive the money for work we already did. That's accounts receivable. One other scenario, see if you're able to grab this a little bit more. What if the guy that we're discussing our trip says, look, I really want to do this trip, but I can't do it today. I want to buy a ticket today, and I'll be on the tour next week, a week from today. Is that a transaction? Guy puts down $25 for a ticket. We give him a ticket, but we're not giving the tour until next week. Yes, that's a transaction. It's an economic event. What two accounts are affected by that economic event? We just took a deposit on a tour from a customer that we owe a tour to next week. What two accounts are affected? Open question. What two accounts are affected? Not accounts payable, because it's not a bill that we owe. Accounts payable are bills that we owe within 30 days, right? So that's not a bill. We don't owe a bill. But we did get this guy's money up front. So we do owe him something. Let's go back up to Michelle. Unearned revenue. Yes, Paul is correct. That's unearned service revenue. We collected, remember, that's why I was saying it's very important to know what the accounts are, right? Because everything about accounting, in accounting, is about the accounts. Guaranteed. I can guarantee you that. So it's unearned service revenue because in this case, we owe this guy a tour, right? What else is affected? Remember, it's a dual effect. Two accounts are affected. Unearned service revenue is definitely affected because it tells us we owe him a tour. Remember, he just gave us, he paid for that up front. Cash, thank you. So we have more cash. We have his cash, but we can't say it's ours yet because we owe him a tour. So that's why it's an unearned revenue. Does everyone see? This is the exact type of analysis we need to be doing in this. This is what we're learning today. This is tough work. This is tough work. Okay. All right. So in the very last scenario, we paid rent. Now, I don't know about you, but my landlord likes to be paid in cash, nothing else, okay? In other words, I have to write him a check or transfer the money in. Usually landlords don't like to get paid in anything other than cash. Most businesses actually rent their spaces, okay? Most businesses actually rent their office space. They rent their retail space. They don't really own the building. Some companies do. But most of them don't. It's all rented space, which means that they have to pay rent every month. Okay. Well, if they have to pay rent every month, it is an economic event. It changes the financial position of the company. So yeah, we're going to be doing some accounting on that. The question I have for you is an open question. What two accounts, remember, it's a dual effect. What two accounts are affected when we pay rent? Okay, great. So Ryan, correct. So two accounts are affected. Number one, when we pay rent, that's a cost of doing business, that's a rent expense. So that is definitely an account that's affected. And like I was telling you over and over again, you're paying cash, okay? The vast majority of your expenses are paid for in cash. There are exceptions you'll learn about in the next chapter. But so cash is going to be affected and rent expense is going to be affected. Okay. So good. Excellent. Now you're thinking more analytically, which is what you need to do in this chapter, this part of the chapter. Well, actually, from now on, let's put it this way, but this is what this chapter is focused on. All right, you've already known the basic equation in accounting is assets equals liabilities and stockholders' equity. But what we really need to do when we're thinking about stockholders' equity is we need to broaden our perspective of what we learned earlier. So what did we learn earlier? We learned that the income statement gives us net income. That net income is then moved to the retained earnings statement. We take dividends out, and that is the balance in retained earnings, and that goes to the retained earnings account on the balance sheet. So in essence, what you've got here is an expanded look at stockholders' equity. Stockholders' equity has two main accounts: common stock, which is when the owners get shares of ownership for their investment of cash. But look at retained earnings. We have to start thinking differently about retained earnings because retained earnings has the income statement, right? Revenue minus expenses gives us net income, right? Net income is going to be the difference here. And net income minus dividends is the retained earnings balance, which we transfer to the balance sheet. Remember this from chapter 1, right? I mean, and chapter 2 to some degree has retained earnings account listed. This is a broad view of retained earnings. Revenues and expenses are your income statement. That gives you net income. Net income gets put on the retained earnings statement. We take away dividends. The balance that's left is retained earnings, and that gets transferred to the balance sheet. So in essence, retained earnings is sort of the summary of the income statement and the retained earnings statement. Okay. Retained earnings means it's the profits of the owners that have been retained, right? Stockholders are the owners. This is the profits of the owners that have been retained, which means that the profits, as you know, which we call net income, is really because revenues are higher than expenses for that period of time. When you have more revenues than expenses, you have a profit or a net income. So in essence, revenue always will increase retained earnings because it's the source of the profits of the company. Remember, retained earnings is the same as retained profit. Right? So revenues basically increase retained earnings because that's the source of the profit of the company. Well, what do we do with expenses on the income statement? We take them away from revenues, right? Expenses basically is using our revenues to cover the cost of the business. The more expenses we have, the smaller profit we have. So in essence, you can look at it as expenses actually take away from retained earnings of the company because they're lowering the profits of the company. Okay. And you just have to look at an income statement to know the difference. Revenues are listed first, expenses are subtracted from the revenues, and you have net income, which is just more revenue left over. Right. And so the income statement is provided right there. It should be looked at as a part of retained earnings now. What you get from revenues minus expenses is the net income of the profit. That net income is moved to the retained earnings statement. We take away dividends, right? What do we do on the retained earnings statement? We add the net income and we subtract out the dividends. That gives us a balance in retained earnings. And we move that over to the balance sheet. So in essence, dividends takes away from retained earnings. It takes away from the retained earnings because though that money is going outside of the company, meaning there's less retained earnings being kept in. So this is how you need to view. This is on page 94, and I think it should be studied. This is illustration 3-2 on page 94. You really need to get this, understand the expanded version of the balance sheet. Oops. All right. Can everyone still see the PowerPoint? Yeah, okay, sorry, a little slip up there. All right, the next several slides are from page 94 to page 99 in your book. Learning Objective 1 of Chapter 3. These are events that happen to Sierra Corporation, and this is ultimately the effect that it has on the accounts. Remember, if it's a transaction, it has an economic, it's an economic event that changes the condition of the company financially. And if that is a transaction, then at least two different accounts are affected by each transaction. Okay, so let's take a look at this event. Event number 1 happened on October the 1st. This, by the way, this is how corporations start. So this, you're going to see this over and over again, dozens and dozens of times. Cash of $10,000 is invested in Sierra Corporation. in exchange for $10,000 worth of common stock. So obviously, the company just received a whole bunch of cash because now the company has owners. Common stock represents shares of ownership. So we have more cash, as you see here, and we have more common stock, as you see here. The plus indicates simply that we have more of it. This is not accounting. This is analysis to prepare you to do the accounting, okay? This is simply the analysis. You'll never ever look at an accounting record book and it'll have plus 10,000. That's not how it's done. You're going to learn that on Thursday. You're just learning how to do the analysis. What accounts are affected and how are they affected? In this case, cash is affected and there's more cash by 10,000. Common stock is affected, 10,000 more. Okay, that's basically all this says. Event number 2, which is on the bottom of 94 and the top of page 95 if you have your book, also happened on October the 1st. What you'll notice for these transactions in accounting is we keep track of them as they happen. So it is a sequential listing of things in the accounting record, as you'll see. Sierra Corporation borrowed $5,000 from Castle Bank by signing a 3-month, 12%, $5,000 note payable. So when you get a loan, and I don't know how many of you have actually had that experience, so I will tell you, from a business perspective, when the bank approves a loan to the company gets the cash. Okay, the company gets the cash. So here you see that cash was affected by $5,000 because they just got a loan. Once you get approved for a loan, they give you the cash, so you can use it for what you said you were going to use it for. Okay. But you also signed a notes payable. Notes payable, as you know, is a liability. So now you have more notes payable by 5,000. Right. So cash is affected because when you get approved for the loan, they give you the cash, so you got more cash. Notes payable is affected because the reason you got that cash is because you have a notes payable. You have a liability to pay now. Okay. So those two accounts are affected, and there was more cash and more notes payable. In essence, more assets and more liabilities in the broad sense. All right, we're moving on to event number 3, which happened the very next day, October the 2nd. Again, this is all about Sierra Corporation, that guided services company that's in the book. Okay. They purchased equipment by paying $5,000 cash to Superior Equipment Sales Company, blah, blah, blah. Okay, amen, hallelujah. Well, again, they just bought equipment. If you purchase equipment, you have more equipment. So equipment is affected, the equipment account is affected. How is it affected? There's $5,000 more of equipment now. Okay. But you just used $5,000 of cash to get that equipment, so you actually have less cash. Cash is affected because you used cash. So you have less cash now by 5,000 because you bought the equipment. In this transaction, we had only 2 asset accounts affected. One asset account went up, one asset account went down by the same amount. So nothing really changed for the broader equation. Okay, event number 4 also happened on the 2nd of October. And it looks like Sierra Corporation received a $1,200 cash advance from Mr., Ms., Miss Knox, whatever, a client. Okay. That cash advance means the customer paid us up front. So that should tell you that 2 things. One is we just got a whole bunch of cash. So the cash account shows that we have more cash by $1,200. But now we owe this customer a whole bunch of tours, $1,200 worth of tours. So in essence, we owe the customer more. We owe the customer tours by $1,200. So those two accounts are affected with event number 4. This is on the bottom of page 95. Now I'm turning the page to page 96 for the next event. And this is where your book can be really handy because a lot of these transactions are either going to be very similar going forward or actually the same in some cases. Event number 5 happened the very next day, October the 3rd. Sierra Corporation received $10,000 cash from this other company for guided services performed. I want you to notice this word, performed. The word performed means you've already done the work. If you've already done the work, it's revenue. It's revenue. So you have more revenue, again, because this is where the profit is, you have more retained earnings. That's how we look at it in the broad picture. And of course, they paid you in cash, so you got more cash here, okay? Cash account, more cash, more revenue, because you performed services. Remember, Sierra Corporation does tours. That's how they make their revenue. They sell tours, they perform tours. Once it's performed, they certainly have earned it. Revenue is earned. This is unearned because they haven't done the work yet. This, they've done the work. No. Again, if you want to know accounting, study those accounts. It tells the story. Event number 6 also happened on the 3rd. Looks like they paid rent, ouch, for the month of October, and they paid it for $900 cash. We've talked about this earlier, so we know for sure that we have less cash. But we also know that our rent is an expense, and expenses take away from the profit of the company. So in essence, we have less retained earnings, less profit. Event number 7 happened on the 4th of October. Sierra Corporation paid $600 for a 1-year insurance policy. So they just bought a bunch of insurance for a year. Again, when you buy insurance, you know it's an asset called prepaid insurance, okay, when you buy it up front. When you use the insurance policy month to month to month, you'll have an insurance expense for each of those months. But you bought a policy that's good for a whole year. You can't expense it up front. It's an asset. So here you show more insurance by $600. And of course, you have to pay cash for that. Okay, so you have less cash and more prepaid insurance. Event number 8. I love that number. If I had a puppy, I think I would name him Ocho. Here, Ocho. Okay. I'm done. So, it's October the 5th now. Notice again, sequentially is how we keep the record. Sierra Corporation bought supplies on account. This is a very, 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 very important little phrase. It's a 2-word phrase, but on account means, in this case, since we purchased these supplies, we're going to pay for them later. On account simply means we received a bill to pay. Okay. So when you buy stuff on account, you are basically buying the stuff, so you get the stuff right away, but you got a bill now to pay later on. So what just happens? Well, they just bought a whole bunch of supplies, $2,500 worth of supplies. So they have more supplies. But this comes with an invoice. Accounts payable. It's a bill that's due within 30 days, right? Accounts payable. So there we have the $2,500 of supplies and $2,500 of an accounts payable, because we walked out of the store with the supplies and an invoice to pay or a bill to pay. Event number 9 happened on October the 9th. Ha ha ha. Looks like they hired 4 new employees. All right. Well, again, what we're looking at in accounting is what's happening right now. When I hire someone to start work next week, it's not a transaction. It's not a transaction because I didn't give them money right up front. I mean, literally, if you got hired for a job and they say, oh, well, we want to pay you $50,000 a year to work for us. You say, great, yeah, where do I sign? Oh, okay, I'll see you Monday. They don't give you the check up front. If they paid you the $50,000, oh, you wouldn't show up to work on Monday. You'd be in Bahamas or something if you could. So some COVID restrictions still. But you'd be traveling. You'd be out of here. You wouldn't go to work. I know it. Can't lie. When we hire someone, it's not a financial transaction. When we pay them, yeah, it is. But since no one's getting paid up front, it's nothing to do in accounting. That's how we look at it. Okay, nothing changed financially. We're going to have 4 more employees on Monday, but nothing changes right now. Okay, nothing will change, in fact, until we pay them. That's when things will start changing. But before nothing happened. So no accounting is done here. Event number 10, by the way, if you're following along, I'm already on page 98. Event number 10 here happened on the 20th of October, and they ended up paying a dividend of $500. Now, dividends are normally paid in cash. There are other types of dividends, but they're normally paid in cash. So we have to assume it's a cash dividend. So certainly if you're paying out cash, you got less cash. So cash is definitely affected, and we have less of it. But look what happens. Dividends take away from retained earnings, right? When you look at the retained earnings statement, we're taking the dividends out, right? So in essence, dividends take away from retained earnings. So retained earnings has been drained by another $500 here. Event number 11, okay, once. Those employees have worked 2 weeks. It's now the 26th of October, and now we have to pay them $4,000 in salary. So this is definitely a transaction. When we pay employees, we have a salaries and wages expense. So when you have a salaries and wages expense, just like all the other expenses take away from the profit. And so what you have is less retained earnings, in essence, less profit. And of course, you're paying them in cash, so you have less cash. And this is basically, what you're going to be doing for work. Okay. That's objective 1 in chapter 3. Critical to know. We look at things in the moment, okay, in accounting. Did things change right now as it was happening? That's why when you hire someone, financially nothing changed right now. So there's nothing to do in accounting. It's not a transaction. But it became a transaction after they worked for us and we had to pay them. Right. Then the financial condition of the company has changed. This is how you have to think in accounting. Okay, you have to think what's happening right at the moment, not what's going to happen. Okay, so that's important. Another thing to know is what I would get used to is understanding how that income statement folds into the retained earnings statement, because you see the connection there. And then the balance ends up transferring to the retained earnings account on the balance sheet. So we actually have an expanded balance sheet that we learned about today. That's critically important to know. Critically important to know, to understand this. Revenue is the source of the profit. So revenues, in essence, increase retained earnings because that's where the profits are. Expenses take away from that. Dividends take away from that. That's why it's set up the way it is. Okay, you got to think about what did I do with these expenses on the income statement? Well, I took them away from the revenue. So in essence, I'm taking them away from the owner's profit because the profit's in the revenue. What did I do with dividends on the retained earnings statement? I took them out. Yeah. So if you're taking them out of the statement, you're certainly taking them out of retained earnings is the good way to look at it. So that's very important. Dual effect. At least two accounts are affected by every transaction. If something happened, two accounts are affected by it. Okay, guaranteed, guaranteed. And you saw that as we went through, right? Each transaction, two accounts were affected by each transaction. In some cases, there's more than two. We're not there yet. But in more complex situations, there's more than two accounts that can be affected by a transaction. But thankfully, you're at the beginning. So we're going to stick to some basic stuff. All those events need to be analyzed. We're not doing accounting yet. We're just identifying what accounts have been affected and how they can be affected. The good news for everybody is they can only be affected two ways. You can either have more of something in an account or less of something in an account. That's how accounts work. Make believe it's your savings account. Only two things can happen to your savings account at the bank. You can put more money in it, or you can take money out, which means there's less money in it. That's it. That's the only two things that can happen to accounts. You have more cash or less cash. More supplies or less supplies. More debt or less debt. That's it. That's the only two things that can happen in an account. That's the beauty that's coming soon. So two accounts are affected, and they're affected in ways that could either, there's more of one or more of both, less of both, more of one, less of another. I mean, that's what the analysis is really kind of about. That's what you're really kind of getting at here. Okay. This is not accounting, it's analysis. You're practicing identifying the accounts and what happened in the accounts. This is critical because we're going to be doing accounting on Thursday. And in that sense, you're going to be learning a little bit of a new language on Thursday, how accountants talk about what more cash is and what less cash is. There's actually names for them. And you'll learn about them on Thursday. But right now, all you care about is how to analyze a transaction. That's your main goal between now and when I see you on Thursday. And I think I'm going to cut off the homework by 2:00 because because this is not something we go back to. This is just something that we have to know so you can know how to do accounting. I don't go back to it. It's not worth reopening because this is not how accounting is. We're not doing accounting yet. We're simply doing analysis. We will be doing accounting on Thursday for sure. And once we start doing accounting, like real accounting, start talking like accountants, it never changes. It doesn't change for the rest of this course. It's the same in managerial accounting. It never changes. That's why it's important to learn it, because it's going to be part of your language in finance and accounting forever. This is how they talk about it in business. This is how they talk about it everywhere. So if you're serious about being a business student of any sort and understanding how to contribute to the company being profitable, and you understanding that, then this is the time to this is the place and time to do it. This is why you have to know the accounts and understand it. So please put the time in. That's all I'm begging you to do. And that's pretty much about it.